equity, and debt can be 20 million. Okay, debt can be 20 million in a company. So what is the debt equity ratio? What is the debt equity ratio?
8:2. 8:2.
Debt equity ratio 2:8, right?
2:8.
2:8. Currently, 2:8 is the debt equity ratio. Suppose if I give share repurchase, which will reduce equity, right? Which will reduce equity. So,
Yes.
okay, let's find financial gearing here. Financial gearing. What will be the gearing here? Debt divided by debt plus equity. What will be the percentage of gearing here? Debt divided
0.2.
by debt plus equity, which means 0.2, which means 20%, right?
Yes.
This is the current gearing. Suppose I have given what? Share repurchase. Suppose I have given share repurchase, which means equity gonna reduce. Equity gonna reduce, let's say 60 million. 20 million shares I have repurchased and I have given that cash back. So now what will be the gearing? Now what will be the gearing? 20 divided by 80, debt divided
80.
by debt plus equity, which means
25.
0.25%. Earlier it was 20%. Now it became 25%, which means a 5% increase is here. So if share repurchase is given, then there can be what increase in financial gearing. It's the after effect of share repurchase. Did you get the idea?
Yes, sir.
Okay, fine. Next question. Any more questions?
Sir, one last question. Can you say about that efficient market hypothesis?
Yeah, efficient market hypothesis is not a topic on business finance. It's a topic on business valuation. Okay, we will be discussing business valuation on Monday, I would say. Monday, I will explain what is efficient market hypothesis. Okay, any more questions?
Sir, risk management.
Risk management will be on Wednesday. Wednesday, you can expect risk management. Okay, then
What is the difference between interest cover and interest yield?
interest cover and interest yield. Interest cover ratio means, so I can give you, let me ask you, what profit we are using for paying interest? PBIT, PBT, profit after tax.
Profit before interest and tax.
Profit before interest and tax. So based on the current PBIT, how much time, okay, how much times can we pay interest? For example, if interest cover ratio is 2, which means 2 times we can give interest, you can pay interest based upon our current PBIT. Okay, that is what being discussed in interest cover ratio. Interest yield ratio is how much percentage of interest can we expect from a loan note. Okay, how much percentage of interest an investor will be expecting, the percentage of returns an investor will be expecting from a loan note, interest yield. Okay, dividend cover and dividend yield will be the same like difference will be there. Okay, anything else? Did you get the idea, Yusuf?
Yes, sir. Yes, sir.
Okay, then come on, guys.
That's zero coupon bond, hybrid bond.
Yeah, there are types of bonds. You have to learn different types of bonds. Since it is an MCQ question, I'm not trying to explain the whole thing, but you must be able to understand there are zero coupon bonds. Zero coupon bond means that bond we cannot expect interest. Those who are buying cannot expect interest. The name itself will have the idea. Then
That funding gap and
yeah, funding gaps means for SMEs they do face funding gap, because funding gaps means they don't have enough investors. Small and medium companies, right? They won't have enough investors. They will have small number of shareholders only, and since they don't have enough security for pledging, they will find funding gap. They will find funding gap, which means they will find difficult for funding,
maturity
for
gap.
raising funds. Maturity gap is that small and medium companies do face risk of what they will get long-term fund for sure to SMEs, because they are growing companies, right? Small companies, they will get long-term fund. But for getting short-term fund, it will be difficult, like overdraft and all. Small companies won't get ODs and all. They'll get long-term loans easily compared to short-term loans, because their assets will mature in long-term only. In short-term, they cannot expect their assets to be matured. That's why they will face maturity gap. Then
So what will be the reason, sir, to reduce the maturity gap?
reduce the maturity.
Because they need working capital.
It's a problem of small and medium enterprises. They can raise finance by some other methods. Okay, they can go for some other methods, alternative funding methods, which you have to study. Then anything else?
Sir, that Musharaka and private equity funds are same, sir.
Musharaka and private equity funds. No, Musharaka is an Islamic finance thing like partnership. Okay, Mudaraba is much more like equity. Musharaka is not like equity, it's like partnership and all. Everyone comes with a fund and everyone will those who are coming with a fund will have to participate in the should be participating in the management.
And that SMEs also is there, no, sir. Private equity funds will enter into SMEs and take over the control and
Yeah.
run operations.
It's called venture capital. Venture capitalist companies will invest in small companies, and they will also participate in the management also. Okay, it's not a passive investment. It's what was the opposite of passive? Active investment. They will participate actively in the business. It's called venture capital. Then
Sir, that questions are there, no, sir. Cost of equity formulas,
yeah, cost of equity formulas are there.
dividend growth,
Yeah, that's important. That's why I
dividend,
wrote KE here. KE, you have to find KE. So, for finding KE, there are two methods. Which are the two methods?
dividend valuation model,
Dividend valuation
constant
model.
growth.
Yeah, dividend valuation model. Then one more method is there for calculating KE. For calculating KE, there is one more method called CAPM model. CAPM model. CAPM model. KE can be calculated in two ways: one dividend valuation model and CAPM model. Okay, then
So those all one-time ratios are the opposite of business valuation.
the ratios are the. I didn't get the question.
That all that questions formulas are there, no, sir, for K dividend valuation model.
Yeah.
Those are opposite of business valuation.
Yeah,
In
it's
that
easy.
also cost of preference share.
It's actually easy, right? So for calculating KE, so let me write here. It's easy actually. Okay. KE can be calculated by D0 into 1 plus G divided by P0 all plus G. This is how you calculate KE. So in business valuation, this is cost of capital. We are finding cost of capital KE. In business valuation, we will find P0. So P0 can be calculated by D0 into 1 plus G. This KE will go to here, which means KE minus G. This should be the equation to calculate P0. Okay. As you said, this is just the opposite. For calculating KP, cost of preference shares, the equation is D by P0. Okay. For in business valuation, you have to calculate P0, which means D by KP. As you said, it's just the opposite.
Tax is there, one minus tax.
No, for preference shares, no need of adjusting tax. For debt only, you need to do tax. For debt, do we get tax benefit on dividend?
No.
Why? What is the reason? What is the reason we are not getting tax benefit on dividend? What is the reason why we are not getting tax benefit on dividend? Anyone can tell. It's an open question. Okay, I can explain you. So this is the basic P&L. Sales minus cost. Sales minus cost of goods sold. Okay, COGS. You will get what? You will get
Gross profit.
gross profit. Gross profit. Okay. If you can deduct other expenses from gross profit, you will get no, not net profit. If you can deduct other expenses from gross profit, then you will get PBIT, operating profit.
Operating profit. Yes.
Operating profit. I mean the operating expenses, you will get operating profit, right?
Yes.
Okay, operating profit. Operating profit is also known as PBIT.
PBIT.
Profit before interest and tax. Gross profit will be equal to operating profit. When? When will gross profit will be equal to operating profit? If other expenses is zero.
Zero.
Right?
Yes.
Okay, then this is operating profit, PBIT. Then we will pay interest, which means profit before tax, PBT. Then we will pay tax. We will pay tax at a certain percentage. Then we will get what?
Net profit.
Net profit, which means profit after tax. This is also known as net profit.
Dividends are issued after net profit.
Yeah, dividend. I mean, for ordinary shares, dividend are issued. Then we will also deduct what if there is preference shares. We will deduct preference dividend. Preference dividend, right? Then you will get earnings. If you deduct preference dividend from earnings from profit after tax, that figure is known as earnings, right?
Yes.
Okay, so there are different type of profit: gross profit, operating profit, PBT, PAT, everything will be there, and earnings also there. So let me ask you, which profit is used for paying dividend?
Last profit after dividend, earnings.
Profit after earnings, or else we can say if there is no preference dividend, let's say profit after tax, which is also known as earnings if there is no preference dividend. Profit after tax is known as earnings if there is no preference dividend. Okay, these earnings is used. This profit after tax is used to pay dividend, right?
Yes.
Am I right?
Yes.
Okay, so dividend is paid after paying tax. The profit after paying tax we are using for dividend, right?
Yes.
Then how can we get tax benefit? After paying tax only we are paying dividend. Then no point of tax benefit. For interest there will be tax benefit because after paying interest only we are paying tax.
Yes.
First of all we'll pay interest. Then if we are paying tax, then based on that tax you will get tax benefit. So dividend we are providing after what paying tax. So dividend is not having any kind of tax benefit, right? Am I right?
Yes, sir.
Am I right, Mr. Yusuf?
Yes, sir.
Yes, sir. Okay. So this is what you have to learn. Okay. So do you have any more questions?
Now this topic looks easy, sir.
Yeah, I have already told this topic will look much more easier after this class. Okay. So you can take a screenshot of this. I think you would have already taken the important questions and all. You should have already noted down. Something happened to my screen. Anyway, sorry. So how do you find it? Really helpful, right?
Yes, sir. 100%.
Okay.
Yes.
So kindly suggest our both revision classes and regular classes to your friends. And for the next upcoming session also, my classes will be there. So please tell your friends about our classes. I hope my classes are really helpful. My ambition, my vision is to get everyone. I want everyone to pass. Even though you are not my regular students, I want you to pass. Okay, I know the amount of money that you are putting in. I know the amount of effort that you are putting in. I know the amount of hard work you are putting in. Everything I know, so that I want you to pass. Okay, at least you have to pass, and I want you to score good marks also. Anyway, I'm wishing as all the classes like concluding the whole class. I'm wishing all the best to everyone, and you can feel free to ask any doubt in WhatsApp. Okay, whenever you come across any doubt, please ask me. I can provide you not the answers. I can provide you the idea maybe how to find the answers. Okay, I'm trying to make you learn. I'm not teaching actually. I'm trying to make you learn. Okay, so anyway, all the best. If you have anything to ask, please don't hesitate to ask. Always feel free. So thank you. Good night. All the best. So as I told, the topic I will be discussing in today's class will be business finance. So let me ask you the same way. We will be going the same way. Let me ask you, how much marks can you expect from business finance?
20 marks.
The same thing, 20 to 26. You can expect 20 to 26 marks from business finance, and you can expect a question in section C. Section C, you can expect a question from business finance, but is it necessary that they will ask a question from business finance? No, only investment
No.
appraisal is, I can assure investment appraisal only. The second question can be from working capital, the topics we discussed yesterday, or else it can be from business finance. Okay, so that is what you learn, that is the weightage of business finance. So why did I tell this is a weightage? Because you have to study that way. You have to understand which are the most important things. Okay, so you can scrutinize or else you can prioritize your topics. That's why I'm telling you can expect 20 to 26. 26 marks means you can expect a question in section C, and you can also expect it can be also tested in section B also. B, there will be 3 questions. One question can be from business finance, and you can also expect 3 or 4 MCQs. Okay, that's why I'm writing here 26. Okay, 3 MCQs plus a question in section C, it will be 26 marks. 3 MCQ, 3 into 2, 6 plus 1 into 20, 20. Okay, it's 26 marks. Okay, you can expect that way. That is the maximum you can expect. Anyway, I'm telling we are following Kaplan textbook only, right? In
Yes, sir.
Kaplan textbook, how many chapters are there in business finance? As per Kaplan textbook, how many chapters are there from business finance?
5.
Yeah, there are 5 chapters. Excellent, Sheikh. There are 5 chapters. Okay, it's actually chapter number 15, 16, 17, 18, and 19. Okay, anyway, there are 5 chapters. I'm not telling this in the order, but according to the priority, I'm telling. Could you please tell me which is the most important chapter among the 5?
Business valuation, sources of
No,
finance.
business
Cost of
finance.
capital.
Cost of capital. Excellent, Sheikh. Cost of capital is the most important most important chapter in business finance. So there are certain chapters in business finance, and cost of capital is the most important one. Then could you please tell me which is the second most important chapter in business finance?
Capital structure.
Sources of finance.
Yeah,
Source of finance.
source of finance actually. Next one I would say source of finance. Sources of finance. Source of finance is the second most important chapter. Then the third most important chapter.
Capital structure.
Capital structure theories. Yeah, capital structure theories. Capital structure. Okay, capital structure theories. Then
Dividend policy.
dividend policy. Dividend policy is maybe if you ask me which is the smallest chapter in financial management, I can tell you dividend policy is the smallest chapter. You can study dividend policy with it half an hour. Half an hour, you can study the entire dividend policy. You can set a timer. Okay, how if you think yourself, how can I study dividend policy? Set a timer for 30 minutes, and within that 30 minutes, you can easily cover the entire dividend policy. Okay, that much small chapter it is. That much small chapter dividend policies. And we do have one more chapter, which
Business
is
value.
no, not business valuation. Business valuation is an entirely different topic. Okay, it's an entirely different perspective. Here we are looking at whether we should raise the finance by equity. What will happen if our debt is increased? Everything. It's about finance. Valuation is different. Valuation, they are valuing a company. Here we are thinking about how to finance a company. Okay, equity, debt, preference shares, whatever the thing is. Okay. Anyway, dividend policy, and the final one. One more chapter is there. Which one?
Financial
Financial
ratios.
ratios.
Financial ratios. Okay. There is a one more chapter called financial ratios. Ratios are important for all the papers except I think tax. For tax paper, ratios is not that much important. But except tax,
Sorry?
TX, all other papers in the skill level like FM, PM, FR, AA. Okay, all the 4 papers you must have proper knowledge about financial ratios. There are some ratios you must study. You must understand what is the concept behind that ratio. Okay, never try to by heart the equation. You have to understand why. Always ask yourself for any paper you study. It's not the question what. Always ask yourself why. Why this ratio is this like? What makes this ratio meaningful? Okay. Always ask the question why. Okay, that's how you learn. Anyway, we do have 5 chapters and we do have 20 to 26 marks. And from the whole 5 chapters, you can expect only 3 types of question. I can assure you that from the whole 5 chapters, only 3 types of question can be tested. I can assure you. Only 3 types of question can be tested. Anyway, I'm gonna give you all the 3 types of question. Before that, let me tell you what are the things that you learn in cost of capital. What are the things that you learn in cost of capital? Kindly
Cost
tell.
of equity.
Yeah, you
Cost
must
of
learn
debt.
cost of equity, KE I would say. Then
Cost of debt.
Cost of preference.
cost of preference shares, yes, KP I would say.
Cost of debt.
Cost of debt.
Cost
KD,
of debt, KD. Okay, KD can be 2. KD of loan note and KD of
convertible.
what? Yeah, KD of loan note and KD of bank loan also.
Bank loan.
Bank loan. You must be able to study both KDs. KP is quite easy. KE is somewhat difficult. Not that much difficult. I will explain you. Anyway, no problem. So anyway, after calculating all these, with all these, you can calculate the whole thing called
WACC.
WACC. Okay, WACC you can calculate. WACC, weighted average cost of capital, right? WACC you must be able to calculate. Okay. So that is what you learn basically from cost of capital. You must be able to find WACC using KE, KP and KD and all. And within that, you must be able to learn the CAPM model. CAPM model. It's an important theory question about CAPM model. Then I can also tell you that CAPM model. Then
Degearing and
degearing and regearing method. Yeah, degearing, regearing method. Degearing and regearing method. Okay, degearing, regearing, or else I would say more than that. I would say project specific A. This would be a better idea about the topic. Degearing, regearing is the method, but we are calculating the project specific K here. And one more theory: systematic risk and unsystematic risk. Could you please tell me what is the difference between systematic risk and unsystematic risk?
Systematic risk affects only a specific industry, but in unsystematic, it affects every business.
No, you're wrong. Actually, you told just the opposite one. Systematic risk will affect what?
Entire stock market.
Entire stock
Ah,
market.
yes.
The entire system will be affected, but unsystematic risk will affect only
Specific sectors.
specific sector or specific industry, right? Any specific sector or any specific industry, unsystematic risk. So there is a method called diversification, which means we can invest in different companies. Okay, on which method, on which risk, like systematic or unsystematic, in which risk we can eliminate or reduce risk by diversification?
Unsystematic.
Unsystematic, because in unsystematic risk, it is affecting only a specific company or a specific sector. So by diversification, like investing in different sectors, we can reduce that risk, right? So only in unsystematic risk, you can reduce that risk by diversification. Diversification means we are keeping a diversified portfolio, which means we are investing in different types of companies, different sectors. Okay, then you must also be able to understand between risk versus return relationship. So what is a risk versus return relationship?
If risk increases, return also increases.
Okay, if risk increases, return also increases. Let me ask you, KE will be there, KP will be there, KD will be there. Whatever question you may come across, which one will have the higher value? KE. KE. Why KE?
Equity have more risk.
Yeah, KE will have more risk because ordinary shareholders are taking more risk than preference shareholders, and then more risk than debt holders, right? So KE will be having the highest risk. Cost of equity. Equity shareholders will be facing highest risk. So let me ask you, why did they face higher risk compared to others? Why do they face higher risk? Because
the returns.
Yeah, no,
returns are not fixed.
Their returns are not fixed. Okay, it's up to the company whether to decide whether we have to give dividend or not. Dividend is what the equity shareholders will get as a returns, right? But the company can decide whether to give dividend or not. So their what returns is not fixed, and then they will be settled in the last only. They will be settled in the last after settling what preference shareholders and after settling debt holders only. Means equity shareholders will be settled, and their preference, as you told, their dividend is not fixed. The company can decide, right? Preference shareholders will get dividend for sure, but equity shareholders dividend is not sure, right? Okay. Since then, they are facing more risk, so that they should be given more returns, isn't it?
Yes.
Okay. So that is what risk versus return relationship. Then let me
But
ask.
sir, a small doubt in practical, they will get like that, sir, if you are taking more risk, more return. Because if company has no value at end, so they will not get no, sir, return.
In practically, there is also some more things that need to be considered. But theoretically, this is the answer. But in practical life, anything can happen. Okay. Anything can happen. In stock market, anything can happen, as you will study it later. Okay. This is only, all the things are only theories. Practically, there will be difference. Okay. So we'll discuss everything. Anyway, in sources of finance, we'll be discussing about what are the different sources of finance available to a company. So here you have to learn about debts,
Equity finance.
equity finance. You have to learn about equity finance, and you have to learn about the methods of raising equity finance. Could you please tell me what are the methods of raising equity finance? Please tell me any methods of raising.
Rights issue,
Right
placing,
issue.
Bonus
Sorry?
issues.
Owners.
Placing.
Bonus.
Right issue is there. Then
placing,
placing. Yeah, private placing will be there. Like we can privately give
Share
to a
exchange.
not share
Yes.
exchange.
To stock market, sir.
Public offer.
Public offer. In stock market, we can
Crowdfunder.
no, crowdfunding is not an equity fund raising method actually. It's crowdfunding is actually kind of a debtor. Okay. And anyway, we learned about, I can tell you, public offer will be there. Publicly, we are issuing large number of shares through stock market. It's called public offer. Initial public offer will be there, because before entering into the stock market, a company can issue their shares before entering to the stock market. Are you familiar with Chennai Super Kings?
Yes.
Yes,
yes,
it's an IPL team, right? Chennai
Yes.
Super Kings do had their IPO in 2000. I don't remember the year. They gave their IPO, initial public offer. Before entering the stock market, a company can give their shares, which is called initial public offer. Chennai Super Kings have given their shares. I think one more team from IPL have given their shares. I think maybe RCB. I don't remember. Chennai Super Kings have given. Manchester United. Are you familiar with Manchester United?
yes,
In 2012, again, I think Manchester United also have issued their IPOs. Are you familiar with Lulu company from Kerala?
Yes,
In
sir.
Kerala, it's famous in, like in Hyderabad, there is a Lulu mall. In I think Telangana, there is a Lulu mall, right?
yes,
A big mall. Yeah. In Kerala, also there are Lulu malls, and in it's mainly in Gulf countries. Anyway, Lulu company also have issued their IPOs. IPO means before entering stock market, they will issue their shares. That is what IPO. So one among the method is public offer, and second one initial public offer. Then next one, right issue. We can right issue our shares, right? We can right issue. Right issue means we are giving our shares to the existing shareholders for a discounted price. Okay, if $5 is the current share price, and we may give a discount, which means around $1, for example, and we will give the shares for $4 to our existing shares. So in right issue, what is the biggest advantage we get?
It will, our equity will not be to external.
Yeah, I can. There is a word actually. Dilution of control won't be there. Dilution of control means spreading the control to more people. Okay, dilution of control won't be there. That is the biggest advantage of what right issue, right? Okay, so we discussed about public offer, initial public offer, right issue, and there is one more thing, placing, private placing. We are giving our shares to someone, or for a person or an institution through an intermediately directly. Okay, not to the large public, but to a company, to an institution, or to an individual directly. We are placing. That is what private placing. Okay, private placing, not through stock market. Privately, if you are giving shares to a company through an intermediately like a bank or any financial institution, it is called private placing. So four methods are the mainly. You have to study at least that four methods. Okay, and you have to learn what are the advantages and disadvantages of all the methods. At least you must be able to write up to around 3 marks for each method. Okay, so that is
What
what.
will be the disadvantage, sir, of rights issue disadvantage?
Right issue, as I told, dilution of for right issue, dilution of control won't be there. But the problem for right issue is that maybe our existing shareholders, if they don't have enough cash, they will sell to the public. We might have to sell to outsiders, right? Our existing shareholders should have the cash in order to buy it for discounted price, right? If they don't have
Yes.
enough cash, we may have to sell it to the what outsiders. That will affect our dilution of control, right? Okay, and
Yes, sir. Before
yeah.
all this method, retained earnings will be there, sir. We have to first do from retained earnings.
Yeah, we can take from retained earnings, but it's not a fundraising method. Retained earnings is actually in our own fund, but it's actually not a fundraising method, right? I'm asking about how to raise equity finance. Retained earnings is already raised one. We have keeping. So let me ask you one question first of all. What do you mean by retained earnings actually?
That profit kept aside for future.
Profit kept aside. So what do you mean by reserves?
So
What's the
reserves also
The cash after dividend. Oh,
What's the difference between return earnings and reserves? Anyone? It's an open
say
question.
both.
Both are actually part of profit actually. Profit kept aside.
Reserves
Return
are for
earnings,
long term.
no, I want much more specific answer. It's a basic question, basic accounting thing only. I'm not that much brilliant in accounts. Anyway, I can ask some simple question and make you confused. Okay, what is the difference between reserves and return earnings? I can tell you. The difference between reserves and return earnings is that both are what profit kept aside, but reserves are profit which kept aside for a specific thing. Okay, maybe to give salary or maybe to for something. For a specific thing, if you are keeping the profit aside, then it is called reserves. If you are keeping the profit aside, generally it is called return earnings, right? If it is for a specific thing, then it is called reserves. Anyway,
Future
Uh,
uncertainty, so return earnings will be there.
future uncertainty. I didn't get the question.
For future, anything happened, loss to
Yeah,
recover like this,
reserves is kept for a specific thing. Return earnings we are not keeping for a specific thing. Okay, not specific thing. If anything happens, or we can take from return earnings. Reserves are kept for a specific, maybe to give salary, maybe to give any liabilities there. We can take the amount from reserves. Okay, in bike there was reserves, right?
yes.
Okay, reserve. We do have reserve petrol. So it's kept for any any dangerous situation comes in, reserves you can take. Okay, we are keeping reserves for something specific. Return earnings is something general. Anyway, so okay, let me ask you one more question. Can bonus issue be used for raising equity finance? Yes or no?
no,
Why?
It doesn't bring any
because
cash into the business.
it doesn't
Yeah.
raise any capital.
Yeah, it doesn't bring cash. Bonus issue is what? Right issue is giving the shares for a discounted price to the existing shareholders. What do you mean by
Yes.
bonus issue?
Instead of dividend, we can give bonus issues.
Yeah, Yusuf, what you said was right, but I'm asking, what do you mean by bonus issue? Instead of dividend, we can give a bonus issue. But what do you mean by bonus issue? You are right, actually, but I'm asking, what do you mean by bonus issue? What is that?
Company issues free shares
A company issues free shares
to
to
existing shares.
existing shareholders. Now you're right. If the company is giving new shares for free to the existing shareholders, if you are giving the shares for free, will we get any amount cash? Our company? No, right? We don't get any cash. We don't receive cash because it's so it is not a method of raising equity finance. Okay, so never write bonus issue as a method of raising equity finance. So we are not getting cash, but our number of shares will be increased, right? Number of shares will increase, but we don't receive cash. Our equity capital won't increase. Our equity capital won't increase. Anyway, after learning all this, you must be able to learn about TERP, theoretical X right price. Did you know how to calculate TERP?
Yes.
TERP is one of the important topic. You must be able to understand how to calculate TERP. And also you have to learn about TSR, total shareholders return. Total shareholders return. So TSR is also an important topic. So please take the notes. I'll come within few seconds. My battery is low, so I have to charge this one. Okay, please take the notes. I'll be back within few seconds. Okay. Many people are leaving, so please don't go. You will feel this session really helpful. So TSR means total shareholders return. So what are the returns that a shareholder can expect from a company?
Dividends,
Dividend,
capital gains.
Yeah, dividend and capital gain. Their share value will increase and also they will get dividend. So there is actually one equation to calculate TSR, total shareholders return. So please do learn the equation of TSR and TERP. Both TERP and TSR is highly probable in session A. In session A, that you can expect a question of TERP and TSR. While learning TERP, you must also be able to understand what do you mean by value of right. You must be able to understand what do you mean by value of right and value of right per existing share. Both you have to learn. Both are really, really important. Okay, anyway, TERP and TSR. Then the next thing you have to learn is about SMEs. What do you mean by the term SMEs?
Small and medium enterprises.
Small and medium enterprises. So you must be able to understand what are the problems SMEs are facing. SMEs are facing a lot of problems. So you must be able to understand their problems and what are the solutions they have. Here, you must be able to learn crowdfunding, peer-to-peer funding, everything. Okay, those are the solutions and the problems also you must learn. Anyway, SMEs are there. So then venture
TERP,
capital.
meaning of TERP is nothing but value of share price after the issue of rights.
No, that's a big mistake actually. Don't think that way. It's not the value of share price after right issue. It's the value of share price after right issue theoretically only. That's why theoretically, it's as I told earlier, it's only a theory. theories cannot be true always, cannot come true always. It's only a theory. Theoretically, this should be the share price, but as per market condition, share price can vary. Okay, so I always tell the word theoretically. So TERP is the theoretical share price after right issue. Okay. Then you must learn about venture capital. Venture capital is nothing but large companies or large venture capital companies will invest in small growing and highly growth potential companies. That is what venture capital is. Tata do have venture capital, Reliance do have venture capital firms, and many companies do have venture capital firms. So you must be able to understand what is venture capital.
The venture capital acquire below 50%, shareholding.
Venture capital requires below 50%. No, you are not learning any percentage in F1. Okay. You're not learning any kind of percentage in venture capital in F1, financial management paper. Okay. Anyway, SMEs are there, venture capital firms you have to learn. Let me ask you one more question. What do you mean by normal debt versus convertible debt? It's a theory question.
Convertible debt is nothing but afterwards we can convert into shareholding.
Okay, so what are the advantages of convertible debt? Could you please tell me what are the
No payment of redemption value.
no payment of instead of redemption value, you can give shares. Okay.
Yes.
But I want much more precise answers. Whatever you told me was right. I'm expecting much more precise answer. What are the advantages of convertible debt over normal debt? So convertible debts do have lower service cost. Service cost means we need to give only lower interest, right? For our company, why we are paying lower interest for convertible debts?
Because we are getting an advantage in future shareholdings can we get?
No, we are not getting. We are the company. We are the financial manager. The investor is getting an advantage that he can convert into shares in future. Okay, that's why we will expect only lower returns. So we have to give only lower returns. So do have less service cost. And convertible debts do have higher marketability because of the conversion option. Convertible debt will have higher marketability because of the what you do have an option to convert. And convertible debt will feel more attractive. Convertible loan note will be like more attractive to the investors. So it is good for startup companies. If a startup company is issuing loan note, then they can go for convertible debt because after a few years their shares will go up, right? The investor will be knowing that this share price will be going up in future, and investor will invest in such loan notes. So these are good for startups. So the whole thing I discussed was the advantage of convertible debt over normal debt. It's a frequent question nowadays. Frequent theory question nowadays. Normal debt versus convertible debt. Then you have to learn about Islamic finance. So what do you mean by the term Islamic finance?
Islamic finance
based on Muslim Sharia and Quran.
Islamic finance is a finance based on Muslim Sharia law and also what based on Quran. Okay. So Islamic finance is
motive is to not earn interest.
Yeah, not the motive actually. It's not the motive. Okay. In Islam, in the religion Islam, it's actually interest is prohibited. What do you call interest in Arabic?
Riba.
Interest is called riba. Riba is actually prohibited in Islam. So we have to consider that interest has to be prohibited if you are going for Islamic finance. Okay. So let me ask you, what is the difference between normal finance and Islamic finance? What are the difference?
In Islamic finance, there is no concept of interest earning.
Interest is prohibited. Prohibited in essence, it is called dash in Islam. It is called in Arabic haram. Haram is the word for prohibited. Okay. Then one thing you told me.
Profit sharing is more encouraged in Islamic financing.
Profit sharing is more encouraged. Okay. We have to share the profit. Then
based on Muslim Sharia law.
It's based on Muslim Sharia law and Quran. Okay. And Quran. Then anything? Can we invest in prohibited activities like alcohol in Islamic finance? If you are going for Islamic finance, can we invest in prohibited activities like alcohol, prostitution, or something?
No, gambling.
No, we gambling. No, we cannot invest in all the stuffs, right? There should be risk. There should be risk. If there is no risk and you are getting returns, then it has to be interest. So we have to take risk in Islamic finance. So the whole thing differentiate Islamic finance from normal finance. Okay. Then there are 5 contracts you must be able to understand. 5 contracts of Islamic finance. Which are the 5 contracts? Yeah. The 5 contracts are Mudaraba, Musharaka, Ijara, Sukuk, and Murabaha. So there are 5 contracts. You must able to differentiate the whole thing. Okay. I'm not telling that you must learn. You must understand the difference between the all the 5 Islamic finance contracts. Okay. So what are the alternative methods we can use for a company in terms of Islamic finance? Okay. So that's you have to learn. What are the alternative methods according to Islamic finance? Anyway, you must be able to, I'm not going to teach you the 5 methods. I can tell you there are 5 methods. Mudaraba, Musharaka, Ijara, Sukuk, and Murabaha. The whole 5 things you have to learn. Okay. Anyway, next chapter would be capital structure theories. Here, in this chapter, you are learning how much.
Can you say that? Sir, can you say about that? All 5 are there, no, sir? Instead of what all purpose are there for Sukuk, Ijara, Mudaraba?
Yeah, I can give you a partial description of everything. Okay, Mudaraba, it's a kind of equity finance. Okay, there are people who are coming in and investing, and there are people who are coming in and managing. Like there are shareholders and managers in a company, right? Similarly, Mudaraba is also, there will be investors and there will be managers. Okay, investors do have a name and managers do have a name. Investors are called what?
Musharraf.
Rabal Mal. In Mudaraba, investors are called Rabal Mal, and those who are managing are called Mudarib. Okay, Musharaka is something different. It's like partnership. Everyone comes in, everyone are part of the management, and everyone are taking the returns. That is called Musharik, right? Musharaka or
Yes.
Musharaka we can call. Okay, then Musharaka will be there. Next one,
Murabaha.
Murabaha. Yeah, Murabaha. Sorry, not. I can give you another thing. Sukuk. Sukuk is like a loan note. In Islamic finance, we cannot issue loan note and collect interest, right? Instead of that, we will issue loan note, and without giving interest, we will give an ownership of an asset. Whatever the profit that asset is making, the one who bought that loan note, the Sukuk, will be able to get the returns. Okay, will be able to get the returns from the profit generated by that asset only. Okay, that is what Sukuk is. Then Ijara. Ijara is a kind of leasing. It's a kind of leasing. And finally, Murabaha is there. Murabaha is like taking the loan. Okay, Murabaha is like taking a loan. I'm not going to discuss the whole thing. It's we do have what limited time only. I can tell you this is what that. Okay,
Yes.
on our proper session, if you would have asked the same thing, we do have more time, so I would have told everything. Okay, now I cannot tell everything because if we are in a hurry. We should go and see. We should learn everything in a shorter perspective. Okay, that's why I'm not going to tell the whole thing. I can tell you these are the things you must be studying. I'm not going to teach you, but I'm telling how to learn. Okay, I'm not teaching you, I'm telling how to learn. Okay, anyway, capital structure theories are there. So it's nothing but what is the capital structure? Capital structure means how much percentage of equity, how much percentage debt should there be in a company. Based on that, there are some theories. Could you please name some theories? Capital structure theories.
Traditional theory.
Traditional theory. First of all, they introduced a theory called traditional theory. Then after that, two scientists came, and then they introduced one more theory, and their name is M&M theory. What is the full form of M&M theory?
Modigliani.
Miller.
Miller theory.
Modigliani and Miller theory.
1958.
1958. Very good, Yusuf. You are more accurate than everyone. It came in 1958. Later, after a few years, M&M theory without tax first introduced. Then after a few years, they introduced the impact of tax. Modigliani and Miller theory with tax. Okay, first of all, they didn't find the impact of tax. Then they took tax. If tax is there, what will happen? Okay, that is what Modigliani and Miller theory with tax. Then
Pecking order theory.
Pecking order theory is that. Practically, most companies are following pecking order theory. So it's one of the most tested question among these theories, pecking order theory. So let me ask you, in pecking order theory, where shall we find the what capital first? First
Return
rank
earnings.
return earnings. First we will take from our own profit, which is called return earnings. Then second,
Debt.
debt because we do have tax benefit on debt. Then third,
Equity.
equity. Okay, so that is the order in pecking order theory. Anyway, yeah, debt first, return earnings, then debt, then equity. You have to learn the reason also. Why return earnings comes first, why debt comes in second, and why equity is coming in third position.
Because of reason of risk, I guess.
Yeah,
More
reason of risk. There are more reasons. You must be able to learn that in pecking order theory. Anyway, then you have to learn why. What are the problems of high level of gearing? What are the problems of high level of gearing? Problems of high level of gearing. What are the problems of high level of gearing?
bankruptcy risk.
Bankruptcy risk. Tax
Agency
extortion will
cost.
be there. Agency cost can be there. Then
Impact of borrowing.
yeah, it will affect our borrowing capacity. Then
Increase WACC.
it will increase the WACC. Since more gearing, the investors will need more returns. That will increase the WACC. Then
Restriction in article of associations.
in article of association, there can be restrictions. So all the thing you have told, everything you have told are perfect answers for a question. Okay, a question of problems of high level of gearing. Okay, so that is what you are learning in capital structure theories. Anyway, on next chapter, you must be able to learn 3 theories only. Dividend policy. It's a small chapter, very small chapter. Within half an hour, you can learn the whole theory, the whole chapter. There are dividend irrelevancy theory, which state that dividend is irrelevant. Even if you didn't give dividend, it's not a problem. That is called dividend irrelevancy theory. Then residual theory is there. And finally, dividend relevancy theory is there. Dividend should be relevant. This is the most important theory in dividend.